All right, beautiful. Listen, everybody, I wanted to do a quick stream, kind of share some charts. You know, I'm getting a lot of questions asking me, hey, JC, do you think that the weakening breadth is going to lead to a market correction? And I just want to be clear about this. The weak breadth is the definition of a market correction, right? Some people might want to call it like a stealth correction. You know, that's something some people call it. But let's take a look. So here we're looking at, you know, in my opinion, the charts that really tell the story of what this market has been in 2021, right? So 2020 was a completely different type of market. So let's take a look at this. So we're looking at the small caps, and then we're looking at the micro caps. And you can see just a chop fest, right? That's really the idea here. And sure, we're gonna look at the S&P and the Nasdaq and a few others in a second, but if you wanna know what's really happening underneath the surface, it's that. Which is really characteristic. Again, I keep pointing this out. A messy, choppy market is really characteristic of year 2 of a cycle, right? We had a monster thrust. I think it was like, depending on, it was like the best 52 weeks since like 1940 or something ridiculous like that. So like, you know, obviously a major thrust. That reminds me an awful lot of the 2009 lows and what happened in 09 and then what happened in 2010. Chop, chop, chop. Right? Same thing off the 03 lows. What happened in 04? Chop, chop, chop. Saw the same thing in 1984 after that first initial thrust. Saw it in the mid 70s as well. So, you know, the point I continue to try to stress is that if the market wasn't a mess, if this wasn't what we were seeing, then that's what would be unusual, right? The fact that things are a mess is, I don't know, like pretty freaking normal by all sorts of historical standards. So, all right, they're like, well, JC, the indexes are making new highs. Well, yes, some large cap driven indexes, particularly the United States, are making new highs. Look at the New York Stock Exchange Composite, right? Making new highs, and the average drawdown in New York Stock Exchange Composite stocks is about 17% in terms of drawdown. Look at the Nasdaq Composite. Now remember, there's a lot of junky stuff in the Nasdaq Composite, so the fact that the average stock there is down 26%, I don't think tells the full story. I think if you look at the Nasdaq 100, kind of eliminates the junky stuff. Even the Nasdaq 100, that has the index itself has done well. The average stock in there is down 10%, right? So you want to talk about whether or not we're going to see the correction. In my opinion, based on the data, we've been in a correction. You can argue since February, you can argue since May, you know, pick your starting point, but we're not waiting for a correction. We've been in one for quite some time. Look at the IPO index, you know, again, classic example, new highs in the S&P 500. And then when did the IPO index peak? In February, right? When a lot of things peaked. The Nasdaq advanced decline line peaked in February, small caps stopped going up, things like that. Speaking of peaking in February, look at high beta stocks relative to low volatility, also peaked in February and really just stopped going up as the S&P continued higher. Same thing with Australian dollar versus Japanese yen. Again, these are indicators of risk. They have been going higher when stocks were going higher last year. Just further evidence that this year is just not last year, right? We're in a different market environment. In my opinion, we have been in a healthy stealth correction, if you will. We're on month 6 of that, by the way, so it's certainly not anything new. Seeing the same thing in credit, right? Junk bonds been underperforming Treasury bonds for 4 months now, so the bond market is saying the same thing that most stocks around the world are saying, that we've been in a correction, right? The bond market is essentially agreeing with that. Regional banks making new 6-month relative lows, you know, is not consistent with a healthy environment. It's probably something you normally see, you know, in my experience, when stocks are under pressure. Emerging markets getting slaughtered, EEM down back below those 2018 highs. That's a big loss, the fact that they're below the 18 highs. China making new 10-month lows. These things are getting slaughtered. Emerging markets have never been lower relative to the S&P 500. When you look at the EEM ETF, lowest level ever relative to the rest of the market. And where's all this churning really taking place? At the same levels it was taking place in 2007, 2008, right before the financial crisis. So this is the all-country world index ex-US. This is the rest of the world. And where is the mess taking place? The exact same place that it happened last time we were here. So I think it's a very logical area for this to happen. So just to, people, all right, JC, great, what's the damn trade, right? I get it. All right, so that's basically my premise that, we're in a, it's a sloppy market, and more stocks could continue to fall. That's the trend right now, right? So at first, things were not just, things weren't getting worse. They just were getting less good. And now things have been getting worse. So things aren't getting better. They keep getting worse is how I see it. So anyway, I think this is a good time to sort of start getting your checklist, you know, your shopping list, so to speak, together. You know, we've been in a correction. In my opinion, this is month number 6. So it's not anything new. So at some point, this correction is going to be over. We want to know what to look for. This one, Figs, is a mid-cap. It's an apparel manufacturing company. I got wind of this from a friend of mine. Shout out, Brett. You know, listen, you know, what are we looking at? We're looking at resistance in the spring, and then throughout May. This is a new IPO, by the way, and into June, and we broke out in June, and then came back and could potentially be retesting that breakout level. That's what this could be. So I'm looking at about 36 bucks. If Figs is above 36, I think this is a really interesting name from the long side. You know, we love mid caps around here. Talk to any of the old timers, they'll tell you some of the biggest winners of their careers, or a lot of them in some cases, have come from mid caps. We were just joking this morning. Moderna is in our, what we call our Hall of Famers list, which are the largest 100 companies in the United States. And Moderna is now on that list, which I was like, whoa, that's crazy. Because a year ago, it was a mid cap when it first got on our list. So just to show you, the stocks in the mid caps, pay attention to them. I feel like they get forgotten. They're like the Jan Brady's. Pay attention to the mid caps. I think Figs is an interesting one from the long side, but only if it's above 36, you know, with a target up near 50. But if it's below 36, leave it alone, be patient. But definitely one for your watch list. If you have any questions at all, guys, hope you enjoyed this. Shoot me a note, info@allstarcharts.com. I'm your host, JC Peretz. I hope you enjoyed these charts. Shoot me a note. Thanks, guys.